to get a little bit more reaction is Tom Atteberry. He's investment manager at First Pacific Advisors. He oversees $4.7 billion in fixed income assets and says Fed policy has created more rate risk than the market has seen in almost 60 years. Tom, good to have you here with Adam and me. You've been listening along with us to the Fed chairman's speech. Your initial thoughts here on what he had to say? He seemed to be a lot of words of caution here.
Sounded much like what I have heard before. I wouldn't necessarily say new ground's broken. I mean, we're not surprised by the very weak economy. What I do have concerns with is it looks like policy as usual, yet when we look at the effects of the policies of the last couple of years, they've had very muted effects on us as far as deleveraging the economy and as far as economic growth. I was a little struck by his comments on the fiscal policy where he really was wanting to emphasize long term. And when you look at our deficit and you look at our debt situation, in our view, that's something you need to get control of very rapidly, especially as you do have an economy that's highly levered and is attempting to delever and has a lot of strains and pulls on it as far as items for capital.
Well, Tom, so what's the priority? I mean, do you effectively delever the Fed's balance sheet, or do you try to grow the economy with all the easy money? I mean, you can't have it both ways.
Well, it's not so much the Fed's balance sheet that's going to delever, which he didn't really say other than just to reiterate that once QE2 is finished, they'll continue to sort of status quo, reinvest their principal. Deleveraging is going to be from whether it's the financial sector, banks and financial institutions, or the consumer, which are the two biggest people who got levered in this last run-up of economic activity. They appear to be someone that still continues to want to delever, or at best just stay neutral and not take on any new leverage. So that's where the delevering part comes in.
Tom, Bernanke is saying that, he reiterated that the FOMC is going to complete its purchasing of $600 billion of Treasury securities. Economic conditions likely to warrant exceptionally low levels for the Fed funds rate for an extended period. In terms of QE3, any hints that that could be forthcoming?
I wouldn't necessarily saw hints other than it would appear they're expecting the economy to pick up in the second half of the year. And we would start to ask the question, well, what if it doesn't pick up in the second half of the year? Do we go back for some sort of QE3 of some sort in order to try to put money into the system to stimulate activity? Now, interestingly, QE2, while it was somewhat positive for the stock market and positive for the high yield market, if you look at treasuries or you look at corporate bonds, both of those yields increased from the beginning of QE2.
Thomas, I got to ask you, you manage about $4.2 billion. You just heard this speech. What are you doing? Because specifically you invest your money in fixed income. What are you doing with your money having just heard that speech? Does it change your view in any way?
No, it does not change my view in any way. I still look at this as one where I'm going to have very accommodative policy from the Federal Reserve, and I'm looking at interest rates that are less than inflation. So I have a negative real return. And that is something that just makes one realize there's a tremendous amount of risk that one has in the bond market. The other risk piece is if we don't get a recovery in the second half as they are hoping for, do I see somewhat of a QE3, which results in it really rising rates to some degree, as QE2 really led to more rising rates than falling rates. So I look at my risk as being quite high. My uncertainty is being quite high, but the return I can get from whether it's a corporate, a mortgage, or a treasury bond is very, very low.
Well, let me ask you this, Thomas. Rates before the speech, the 10-year was about 3.01%. It's now about 2.98. In other words, bonds are rallying on this, but you sound like someone who wants to short bonds. So what are you doing?
Yes, well, the other thing I noticed was that the 2-year, I don't know where it is right now, but it touched 40 basis points, which is the lowest it's been for this year. So the difference between a 2-year and the 10-year has actually increased some. And what that steepness or difference in yield is telling you that over a long period or sometime in the future, what you are going to look at is higher rates. Steep yield curves are followed by higher rates in the future. That much I'm certain of. But I also realize with a 2-year at 40 basis points and the CPI at 3.2% on a year-over-year basis, I have a tremendous negative real return. in your example of looking at a 298 with a 10-year, I still have a negative real rate of return.
So, Thomas,
neither of those should be acceptable.
Let me push you, if I may, sir. Do you short the 2-year? Is that what you're effectively saying? If it's a negative rate of return, do you actually short that?
We can't actually short it. And one of the things that investors have to realize is if you ever short a bond, you have to pay the interest on it that comes due. We're merely saying is have a very short duration to your portfolio, have very short maturities, protect your capital. I just am not at a fund where we could actually short treasuries or short interest rates in general.
Hey, Tom, let me ask you a little bit about your fund, because it's in the 6th percentile for so far this year and the bottom 22% for 1 year. So what are you guys doing wrong, and what are you doing to change it?
If you look at our fund and what we did, starting in 2003, we actually first wrote a piece called Buyer Strike, of which we saw no real value in long-term, high-quality bonds and would not commit our capital from our clients. If you look at us in 2008, in June of 2008, we reiterated that stance and further said that we wouldn't lend money long-term to fiscally irresponsible entities. You can sort of say a wink and a nod that at that point we were pointing our fingers at the federal government. So we did not want to take interest rate risk because we didn't think you were being compensated for that. We also we felt that the fundamentals of the economy were such that you were going to see a very substandard recovery. And so from that standpoint, we didn't see where credit made great sense for us because you weren't going to see growth in the economy to a discernible degree. Where we missed it was the flood of liquidity that came to the market. So from a technical aspects, prices of bonds, whether they're risk bonds or risk-free bonds, increased while the fundamentals didn't necessarily justify that increase.
All right. Hey, Tom, we're going to leave it there. Tom Atteberry, he's an investment manager at First Pacific Advisors. Right